Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger Associates Financial Planning. I'm again joined by Nick with Nick DeVito, also a certified financial planner, one of the equity owners also of the firm. And so thank you very much, Nick, for joining me.
Yep, thanks for having me.
This is part 2 of the fundamentals of estate planning. This is also the topic that we present to the general public. We've been doing it a couple times in the spring, couple times in the fall for probably 5 or 6 years now at least. Same thing that we teach down at Temple University, but I enjoy teaching it to the public more than I do teaching it to students. I shouldn't tell Cindy that. But the fact of the matter is, at the end of the day, the 20-year-olds don't take on the same level of interest as a group of people who are voluntarily there to learn about it.
For what it's worth, I take a little offense to that because Mike met me at one of his estate planning presentations at Temple. So
anyway,
all jokes.
So anyway, we talked basically about the components of a will, the components of an estate plan, how the will works, what assets go to the will, how do other assets for beneficiaries, registration, et cetera, et cetera. What we would like to do in this episode is talk about the next level up. Okay, the next level up is a little bit more advanced estate planning, not super advanced. This still applies to a lot of people. And the purpose of it is utilizing the trusts that we referenced in the first one, because inevitably what a trust does, and I should point out, a testamentary trust, doesn't have to be a testamentary trust, which is one that's created upon death. But generally speaking, it is usually what happens is that you're creating an irrevocable trust that allows the propagation of the assets for years, decades, and even generations ahead based on my wishes. And that is something that can and will be very important to a lot of people, because we talk to people about this and they didn't realize the impact that a trust can have on allowing them to do the things they want. Because what a lot of people fear is leaving a lot of money to their children and them either blowing it or whatever. There are so many potential pitfalls that, quite frankly, when we bring these up to clients, are like, wow, either I didn't think about that, or like, man, I've been thinking about that, but I didn't know how to handle it. All right.
Yep.
So you ready to kick off?
Yeah, absolutely. I would say that, kind of backing up a little bit, the normal distribution you have for people is one spouse passes away, everything goes to the other one. It just goes right across. The issues potentially arise when you're dealing with what happens next, when it goes to going to the children, for example. It's usually the issue resides around the passing of the second spouse.
Right.
So what are some of those pitfalls Mike mentioned? Well, what if you pass away, leave everything to your spouse, you have children, she remarries, she now passes away, the assets go to her new spouse, and your kids, well, you know what? The new guy didn't like your kids anyways. They're left with nothing.
Correct.
That's a potential pitfall. All the things we're talking about, we wouldn't be saying this if this hadn't happened before. These are real world, real life examples. We're not just making them up. This stuff really does happen. So it's important that you protect yourself to avoid this happening. What are some other pitfalls that happen? Both you and your spouse pass away, you leave everything to your children, you pass away and you have young children. Well, first and foremost, if they're under the age of 18 and you leave your assets to them, they're not going to have readily available access to that until they're 18. Furthermore, if you leave it to them, those assets need to be in something guaranteed, like federally guaranteed, bonds, treasury bills, treasury notes,
CDs, something that's FDIC insured, basically federally insured assets that, for the most part, when they're federally insured, they're probably not earning the same amount of money as they could if there were other types of investments.
Yep, exactly. Furthermore, okay, now your kid is 18, now has access to this money. They're now being thrust as an 18-year-old or at any young age, they're now being thrust with all this money that they now have access to. I always love to ask my questions this. It's passing no judgment on their children, but I say, do you think it'd be wise to leave your kid with $1 million, $2 million, whatever your estate is worth, even $500,000 or less, whatever you have, do you think it's wise to be thrusting that much cash or that many assets onto a young child? They could be the most responsible child ever. They could be the most responsible person ever. That doesn't necessarily mean it's a good idea. Another pitfall that people run into is, well, what if the surviving spouse has different goals than you? What if you wanted all of your assets to go to your children, you wanted to pay for their life and all this fun stuff, and your surviving spouse disagrees with that? Well, once you're gone, if there's not a trust that's established, they can do whatever they want with those assets. Your wishes don't have to be honored unless they're written in a trust.
We have a client that way. Okay, again, so far, everything we've talked about, I've had situations. And so in this particular instance, he knows full well that his wife would probably do different things with the money than he wishes to himself. And, he's the one that all the money's in his name. It's not that he wants to cut his wife out. It's that if he leaves everything to her, then what she's going to do is she's going to flow it on things or leave it to other people than the children, which is what he wanted to do.
Yeah.
I want to go back to the kids for a moment. The phraseology is they say Harley versus Harvard. Okay. You thrust a kid with $1 million who's 18 years old. They're like, what do I need to go to college for? Let's time the party. Okay. Well, the reality of it is what the trusts can do is structure the assets. We're going to talk a little bit more about this, but it structures the distribution of the assets to the child. The other thing is that, I guess I'm going to be going on with this for a lot. Basically, what happens is most people don't realize what their net worth is. Okay. And I challenge you to think about if you were to add up your 401k money, the value of your home, people forget the value of their home, the amount of life insurance that both spouses have.
I would say that's the big one that people don't think about, because maybe they have a few $100,000 in their 401ks in their house. They're like, oh, well, okay. I mean, that's some money, but they forget about the life insurance. And most of the time people have $250 each or $500 or $1 million policies. And you add all that together, to Mike's point, you're dealing with a lot more than just some money at that point.
Right. So what then happens is, and I'll spend some time on it because quite frankly, I've been able to, and this is where I wish I had my board, and this is where I really thrive in the classroom setting. Thank you for the lack of strength of the English language.
But we're good at math here.
Yeah, right.
Speaking English,
right.
No. Math, yes.
Right. So I'm able to use my own family as a perfect example. So I got 2 children. Very different children, all right? One of them is married, one of them is not. First of all, I'm establishing a trust. Let's just assume, for the sake of argument, if I die, I am worth $2 million, and I am not married. So if I'm leaving money to my 2 kids, effectively at the end of the day, they're each going to get $1 million. Now, I established these trusts when the kids were like 12 and 14 years old. And I said, all right, you know what? Guess what? I'm putting it in a trust so that I'll let them have it. 1/3 of it when they turn 25, 1/3 when they turn 30, and then they can have the remaining part when they're 35. Well, guess what? They're both 30 now. I'm like, all right, let's revise this. How about 1/3 at 30, 1/3 at 40, 1/3 at 50? But talk more about it. Okay. So the advantage of my putting money into an irrevocable trust for each of the 2 children is multifold. For starters, those irrevocable trusts are creditor proof. Who is a creditor? Well, if one of them decides to go to the bar and they're coming home and wrap themselves around the tree and kill somebody doing it, trust me when I tell you, if those assets were in the name, the attorneys are getting it, okay? Which means that they're going to get sued. All that money's gone. If that money is in an irrevocable trust, that irrevocable trust is creditor proof, guess what? You get sued, it's gone. It's not going to. I mean, it's protected. Give you another example of a creditor, a divorcing spouse. You get divorced, those monies that are in the irrevocable trust cannot be touched by the spouse. So it's protected against divorce. Then what you do is you create, like I'll create beneficiaries of each of my 2 children's trusts. I'll make it so that if they have children, it goes down to their children in trust. If they don't have children, then it goes to the other sibling. So it gave me the opportunity to then create the ability to protect my children really from themselves. Number one, if they decided, oh, I'm just going to go blow all my money, well, guess what? I set it up that they're not going to be poor, but they can't get all of it at the same time. So in other words, if I left $1 million into each trust, we'll just focus on one. They can't go in there and get the entire $1 million. Okay, great. So what trusts typically do is they have what's called HEMS. HEMS is health, education, maintenance, and wealth support. So, okay. And what it does is I'm saying that I will allow my child to be able to access the money inside that trust for any of those things. They have health issues, break their leg or whatever the case may be. They need $10,000. They approach the trustee, which I assign a trustee for that trust. The trustee's job is to look at the trust and say, yep, you broke your leg. This thing allows a $10,000 distribution because of health. It allows them to take the $10,000 out of the trust for the doctor bills. Education, same thing. I want to go get my master's. I want to go to college, whatever the case may be. The child will approach the trustee and say, hey, I would like to be able to get this money to pay for college. The trustee looks and says, yep, it's written in here. Okay. Which means that me as the person, if I am establishing these trusts, I darn well better pick a trustworthy trustee, because that's the person who is the gatekeeper of the trust. You want someone who can be firm, but you also want someone who is compassionate. Because the other thing that could happen is one of my children may say, I want to have a sex change. Well, they go to the trustee. If it specifies, or if it does not specify in the trust that that's allowable, then the trustee, it gives them a little bit of discretion to say, sorry, it's not in here. The trust can't pay for it. All right. So that's the uses. Maintenance and support are a little loose. Hey, I'm used to living on this particular type of lifestyle.
The maintenance and support could be, well, you know what? I need money for an apartment, or I want to buy a house. And then to Mike's point, that's where there's some discretion in there. The support and maintenance, I would say there's much more discretion there where, okay, well, I need a new car. Well, do you need a $20,000 car or do you need a $70,000 car? And that's where the trustee can say, okay, I'll give you $20,000 for a car. I'm not giving you $70,000 for the car. And to Mike's point, you want it to be someone you trust, because there is a level of discretion that they're going to have to be exercising. You also want someone that will be there. And one thing I believe you have your trust set up is that you have someone set up as a trustee, but oftentimes people choose a trustee. Now there's different types of trustees. You can have a more personal trustee, someone that you know, or there are corporate trustees out there that you can assign an organization or a business that does that. A trust company that is the trustee for the trust. You want someone that's going to be there. And you can also, one thing I always stress to clients is that if you get with a good estate planning attorney, they can build a lot of flexibility so that you don't have to go running back to the attorney to redo the documents every time something little changes. To Mike's point, his trust specifies, okay, when I pass away, it's split between my children. If one of them passes away and they have children, a trust is created for their children. If not, it goes back to the other. But Mike set it up so that his son recently had a son. He didn't have to go running back to the estate planning attorney to redo the trust document. It's written in there that says split equally among Mike's son's living children. So you can build the language in there. Furthermore, I always like to stress, because I think people sometimes get scared with the trust because they figure, oh, I don't want my kid to have no access to it. Another thing I like to stress is you can make the trust whatever you want it to be in reality. Now, one thing I always like to remind people is that the easier it is for their beneficiaries to go in and grab money from the trust, the less creditor protection that is afforded. If they can willy-nilly go into the trust and grab money whenever they want, they get sued. The attorneys can say, well, you have access to that whenever you want, so should we. Pretty much. You can also specify, I know Mike did the 1/3, 1/3, 1/3 example. You can also say, all right, well, you can have 5% of the value of the trust every year. Any income that the trust generates, you can take that every year. So it's very flexible, and you can really make it to cater your needs. And I think that's very important. And if you get with a good estate planning attorney, they will take care of you and make sure your wishes are satisfied.
Exactly. And again, it's the beauty of the trust is it allows you to be able to control the disposition of the assets and to allow for a level of flexibility. So I'd like to talk about one more example of a trust that I use. And then the last segment, we'll take a break. And then the last segment, we'll talk about taxation. Okay. So the other, lo and behold, here I am again. I get to use myself as an example. Okay. I remarried. So now I've got my 2 children and my spouse has her 2 children. So what I decided to do there is say, hey, look, you know what? I love my wife. I don't want to leave everything to her because in theory, she could leave everything to her kids. My kids get screwed, right? Okay. And I'm not saying she would do that, but how do I know? How do I protect? Similarly, she could remarry, and the whole example that you used earlier. So what I did here is a really meshy kind of thing. Is I created a trust whereby when I pass away, some assets go directly to my spouse, joint accounts. I have her named as beneficiary in accounts, but I also have some assets going to an irrevocable trust. Okay. Now, what this irrevocable trust is, because I owned the house before we got married, when I said, hey, look, you know what? Here's the deal. I'm going to put the house in the trust. I'm going to put my life insurance proceeds in the trust, and I'm going to put my business in the trust. So what happens now is you got this trust. It's an irrevocable trust. And what I specified is that she, during the course of her lifetime, can live off the income of the trust, of which the business will be spitting out a decent amount of income. She can continue to live in the house. The income that the trust is generating also pays a lot of the expenses associated with the house. And since I left her a boatload of money already anyway, and what it does is it preserves a lot of the assets for her to be able to live on during the course of her lifetime. But once she passes away, then her assets can go to her children, and the assets that I have in the trust can be distributed, which I actually set it up. I'm distributing it to all 4 children. So, and I could change that. And here's the beauty of irrevocable trusts. They're irrevocable once funded. If they're not funded, which they're not, they're only created on paper in my will. My will says, hey, if I die, the money goes into this trust, and these are the terms of the trust. Okay? If I don't like the terms of the trust today, guess what? I rip up the trust and say, or don't even really rip up the trust. I just change the language in the will that changes the language of the trust to make it the way I want it. That's simple. So, yes, if I want to change, I do have to go back to the attorney. But I'm also smart enough to make it so that the beneficiaries, being my 2 kids, as well as my wife's 2 kids, I make it so that if they pass away, that it goes to their children. And to your point earlier, I say to all natural children. So my son has, at the time I did it, he didn't have any, but he has 1 now. And if they end up having 3, well, guess what? It gets distributed. I don't have to change the terms of the will every time. So we're going to quit here on trusts. We're going to come back after break, and we're going to talk about taxation and strategies for taxation when we return. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained. And what we talked about in the first half of the episode is the utilization of trusts for the sake of helping distribute my assets after death and potentially for years and generations to go. In this last segment, what we're going to be doing is talking about the taxation of estates. And there's two levels of taxation. It's actually three, but I'll go with two from an estate tax perspective. You got the federal and you got the state. The federal is pretty cut and dry. The state, it depends on what state you live in. Okay, they got 20 of the 50 states have either an estate tax or an inheritance tax. The way an estate tax works is if my estate is $2 million, it gets taxed at that $2 million estate tax level. The way an inheritance tax works is it's not based on the value of my $2 million estate. It's based on who's receiving it. In Pennsylvania, let's say, for instance, I decided to split my estate 4 ways. I wanted to split, I'm going to give you all 4 ways. I want to give some to my wife, 0 tax. There's never a tax when distributing from one spouse to another. And that's both federal and that's at the state level. But then in Pennsylvania, you got 3 different levels of taxation. I call it linear. If I leave it to my parents, my grandparents, which seems backwards, or my children or my grandchildren, linear descendants is 4.5%. Sideways, if I leave it to my siblings, it's 12%. And if I left it to someone else, a nephew, a niece, a friend, a cousin, like everything to Nick, it's 15%. I should point out, a stepchild is considered the same as a child. Okay, so that's how it works in Pennsylvania. Like I said, there are 20 states in the United States that have either an inheritance or an estate tax.
So that's the Pennsylvania state level. The federal level is everyone is given the federal estate tax exemption. And what that is basically a $14 million exemption per individual. So if you pass away and you have less than $14 million, you do not pay the federal estate tax. If you are above $14 million, say you have $16 million, you're paying the federal estate tax on the $2 million that you go over. Once again, that is per an individual. So a married couple has about $28 million in a federal estate tax exemption limit. The federal estate tax rate is 40%. You also have gift tax. Gift tax is also 40%. You can gift up to $19,000 to an individual in a year and not pay any gift tax. Once again, that is per an individual. So you have, if you're giving it to your son and his wife, you can give your son $19,000 and you can give your wife or his wife $19,000. If you're married, your wife can also give $19,000 to each of them. So it is per an individual, $19,000 per year. So what happens if you go over that $19,000? Well, if you go over that $19,000 annual limit, you have 2 options. You can say, one, you can pay the estate tax or the gift tax, at 40%, or you can say, you know what, let's take it off the back end. So let's say you go over your estate, you gift $119,000 to someone. You went over your annual gift limit by $100,000. You can take it off the back end, and and what I mean by that is instead of your estate tax exemption limit being $14 million, it's now $13.9 million at the end. So that's what you can do. Oftentimes, and if you do that, there is a little bit of record keeping that goes into that. You have to file an extra form with your taxes, keeping track of the fact that you went over. But that's what oftentimes people will do.
A common use of gifting, and this is something, I get this question all the time. Just got this question a couple of days ago from a client, is we would like to gift our kids $200,000 to buy a house or $100,000 to buy a house. What do? I say, look, there's a couple ways you can do it. You can gift the whole amount, but it doesn't make sense for you to pay the estate tax. Have it come off the back end. If, in this particular case, if there's risk that you could be exceeding the estate exemption later, and they're at risk simply because they're worth a decent amount now, expected to get a pretty decent inheritance, and they're young enough that it could grow.
Mm-hmm.
Okay. And if they ever lowered the estate exemption, they could be in trouble. So I said, all right, let's look at it from a different perspective. Once again, husband and wife, their daughter and husband, they could effectively gift $76,000, but they wanted to gift $200,000. I said, I got an idea. Gift them $76,000 and you'll loan them $124,000. Okay. So what happens now? So I gift him 76. I really gave him 200. $76,000 is considered my gift for this year. I have $124,000. You should document it. Okay. And it requires interest. Fine. So now all of a sudden, January of the following year comes and I say, I'm going to forgive $76,000. Guess what? That's my gift. Now I went from $124,000 to like $48,000 plus interest.
Mm-hmm.
And guess what happens next January?
You gift them the rest.
I forgive the rest. Okay. So that's another right now. If I were to die along the way, then it comes back into my state.
Mm-hmm.
Okay. But I'm just telling you, it's another creative way of gifting more. And if there's a concern with estate limits, that's a way that you can be creative and get around it.
Yeah, that's a great idea. And one other thing I always like to bring up when talking to clients about estate planning is, well, how are the different types of assets taxed when you pass away? For example, you pass away with a retirement account, you pass away with an IRA, and you leave that to your beneficiary. If it's a spouse, they have two options. They can take it as an inherited IRA, or they can take it as their own. So they can basically just take it in and it's as if it was their IRA. If you're leaving it to someone that is not a spouse, if you pass away in 2020 or later, they're required to take it out of a retirement account within 10 years. So an IRA, Roth IRA, 401k, you need to take the money out within 10 years. If you were of RMD age and were taking your required minimum distributions from your account, when you pass away, your beneficiary is going to have to continue those RMDs based on a table of their life expectancy, and it's still subject to that 10-year rule. You have your non-qualified assets, regular investment accounts, your stocks. Your house is considered a non-qualified asset. What happens when you have a non-qualified asset, if you pass away, it receives a step-up in basis. What that means is, say you buy a stock for $10,000 and it's worth $15,000 when you pass away. If you were to sell it during your lifetime, you are going to pay a capital gains tax on the $5,000 in growth. If you leave it to a beneficiary, they are going to inherit it as if they paid $15,000 for it. So if they were to sell it that same day, no capital gains tax. That's the same with houses. You bought your house for $100,000. It's now worth $500,000 and you pass away with it. Your beneficiary receives it as if they paid $500. A common misconception we hear, and people talk about this all the time when we say, don't do that. People talk about gifting their house to their kids. Well, I'm getting old. I want them to have the house. And we say, hold on. Let's think about that. If you gift an asset to someone, they receive it at the same cost basis you did. So sometimes a lot of people come in that they bought their house 50 years ago, 40 years ago for $50,000 and it's now worth $500,000. If you gift it to your kid, they're receiving it as if they paid $50,000 for it. So if they go to sell it, they're now paying a $450,000 tax on the capital gain.
The thing that I would like to impress with that is that there are creative ways that the attorneys can make it so that you could put it into a trust and also get a step up in basis upon death. One of the big things that people are afraid of doing is they don't want all of a sudden have to go into a nursing home and the nursing home get all the assets. And that's, again, a common misconception. That's Medicaid planning. Medicaid planning is something that's out of the scope of this particular discussion. But if that is something that you're really thinking about doing, of trying to get your assets out of your estate, then I strongly encourage you to seek a qualified estate attorney who does that type of planning, because it needs to be done carefully. I'd like to talk to you about some creative ideas that I did with non-qualified assets. Husband and wife. The husband, both of them elderly, but the husband was in poor health and declining. The wife was in good health. Great. So what we did is we took their joint account and split it. What we did is we took all of the appreciated assets and stuck it in his name, and all of the assets that weren't appreciated or that don't appreciate, like bonds and stuff like that, don't appreciate, put them in her name. So lo and behold, a year and a half later, he dies. All those assets they would have otherwise paid a capital gain on got a step up in basis. They go to her anyway. It would have been that way. But if there was a joint account, it would only gotten a half a step up. Mm-hmm. So what we did was we were able to creatively allow them to keep their assets, but divided them in such a way that we were able to manipulate the estate rules to reduce taxes. Why am I announcing this like in the public? The IRS.
Creative solutions. Creative solutions.
And back to your IRA, where you have to take it out over 10 years, a Roth IRA operates the same way. It needs to be taken out over a 10-year period. However, the beauty of a Roth IRA is it's tax-free. So generally speaking, what we look at is saying, hey, you know what? If the Roth IRA is going to be tax-free and it doesn't have required minimum distributions, if you don't need the money, you let that bad boy ride for 10 years where you can accumulate tax-free assets for 10 years.
Yep, absolutely.
So the only other things that they have out there are non-qualified annuities. Okay. Can't stand them, but they exist out there. So if I happen to have a non-qualified annuity that was worth $200,000, but I paid $50,000 when I first started it, if I die, my beneficiaries inherited with no step up in basis. And if they want to close out that annuity, guess what? They're paying tax on that $150,000 as ordinary income. 3 big winners, Mr. I, Mr. R, and Mr. S. Not a fan.
Nope, absolutely not.
So anyway, the other thing that we like to point out as a strategy, okay, we were talking about the non-qualified assets and using them to, for the step up in basis, trying to avoid gifting a house, okay, things along that nature. One of the other things that we've seen and recommended many times before is we take a look at the tax bracket of the elderly person, and we look at the tax brackets of the children. And what we'll oftentimes suggest is if a parent has one child who's wealthy, one child who makes hardly anything, we say, look, leave the IRA to the person who doesn't make that much money because of the fact that they're not going to get taxed as hard. You leave the Roth IRA or the non-qualified assets to the higher income person so that we can reduce the overall amount of taxation. Another thing we also do is, again, we look at the tax brackets of the children or the beneficiaries, and we look at the tax brackets of the people who own the assets. If they're in a much lower tax bracket, you watch how fast I start looking at doing Roth IRA conversions. Because if we convert IRA assets that are owned by the older people as part of the estate planning process, we convert IRA to Roth IRA, pay the taxes at the parent's level or their tax, so that when they pass away, those assets get passed on to their children in my 2 favorite words.
Tax-free.
So anyway, is there anything else that we left out?
No, I think we covered pretty much all
Cool.
of it.
All right. Sounds good. Well, so again, the whole idea is to provide ideas. There's no 2 people are the same. No estates are the same. No children are the same. We encourage you to seek guidance when it comes to estate planning. What we do as a rule is we help our clients understand it. We do not do the actual documents. We rely on the estate attorneys, and we know a bunch of good estate attorneys. We rely on the estate attorneys to actually do the documents. And what we will do is we will explain all of it so that when they go into the estate attorney, they're not hearing it the first time. And so that they kind of have also an idea so that the husband and wife can talk about it and say, what are our goals? What do we want to do? So when they actually do see the estate attorney, then they have a much clearer picture on what they want to do. And it makes the process of developing the wills and the estate plans and or the trusts a whole lot more efficient. So with that, once again, if you ever wanted to ask or find out or understand more, please do not hesitate to call us. Our phone number is 610-422-3773, or you could check out our website. It's www.maaplanning.com. MAA is in Menninger Associates, maaplanning.com. On there, we've got all kinds of resources. And also, there's a place in there where you wish to contact us. You can give your information and a little description on what it is that you're trying to do. So thank you for joining. I hope you learned something. Nick, thank you for joining me again.
Yeah, thanks for having me.
And you have a wonderful day. See you next time on Financial Planning Explained.